We want to stick with the markets here and bring in Brian Levitt. He is the Invesco Global Market Strategist. And Brian, always great to see you here. And I just want to get your market reaction on what's happening today in the markets, because at this time of the year, usually not a lot of volatility, but of course, we have some headwinds.
Yeah, markets don't like uncertainty and particularly policy uncertainty. And so we're dealing with that now on a couple of different fronts. You've got the Federal Reserve, which is now in play, but the Federal Reserve's in play in a slowing economic backdrop that may be exacerbated or will be exacerbated by Omicron. So you've got health policy and reopening policy concerns as well. And so it's a challenge for markets. I wouldn't view this as the end of an economic cycle. Things are going to break down materially here. I would say it's the type of drawdown you typically get around policy uncertainty. Haven't had one in a while, and so it's emerging here, unfortunately, in a lightly traded week in which a lot of people were starting to have their sights set on vacations.
And Brian, I want to ask you, if Omicron does pose a threat, let's say going into January and perhaps into February as well, how much flexibility does the Fed then have to, in its ability to taper? Are they sort of locked in, or do you think they actually have a little bit of flexibility?
Well, they do have flexibility. I mean, it is an independent central bank that's going to seek to pursue price stability and full employment. And the last they checked, prices weren't stable. Inflation expectations were up, and the market had moved, the economy had moved closer to full employment. But they're going to be data dependent. They're going to be economic environment dependent. And so I think the tapering of the asset purchases is largely baked in. The bond market has already priced in a couple of rate hikes if you look at what the short end has done. But could the Federal Reserve back off if conditions deteriorate as a result of Omicron? Sure. Now, elevated inflation perhaps gives them a little bit less flexibility that they have had than they've had in the past. But I would note, if you look at break-evens, inflation expectations are coming down some. So they may be starting to get some flexibility in here if things were to deteriorate meaningfully.
And Brian, I'm glad you touched on bonds. I want to shift gears to the dollar. It's been broadly, well, I'm looking at a chart of the Dixie. Let's do this way. This is a 2-month chart on the Wi-Fi Interactives. Now, this has been trading sideways for about the last month, but we have seen some fits and starts where we see it go up to the top of the range, down to the top of the range, and it seems to be pricing in whatever the Fed is going to do, and perhaps is it going to raise the terminal rate or lower the terminal rate? I'm just wondering what you're seeing in the dollar with some of these other crosses, notably in emerging markets. It's been a disaster in some places like Turkey, but in others, even in the euro, I believe the euro has depreciated about 6-7% against the dollar this year.
Yeah, I mean, Turkey's a very idiosyncratic example. So you want to look at it on a broader basis, or as you were doing there, on a trade-weighted basis. I'm actually pleased to see that the dollar has been relatively behaved. Financial conditions have been relatively behaved in all of this. And so the reason you want to watch the dollar is it's a good risk barometer. And if you remember in 2015 or 2018, when the Federal Reserve was raising rates in what was still a weak growth environment, the dollar strengthened. And that led to concerns about a recession. Financial conditions tightened meaningfully. This time, that's not the case. And there's a couple of reasons for that. One, inflation's elevated here. So the currency market is viewing it as the rightful move of the Federal Reserve. And two, the Fed is not the only country or the only central bank raising rates. There are many central banks around the world raising rates. So you are not seeing a significant move in the dollar. That's very favorable. You would start to worry about this cycle. You would start to worry about markets significantly more if you saw the yield curve flattening more meaningfully, high yield spreads blowing out, the dollar strengthening meaningfully. And that has clearly not been the case, which is certainly promising in my perspective.
And then, Brian, so what's your base case for when does inflation tame and when does growth sort of normalize? And then tied to that, we just saw Manchin all but kill the Build Back Better plan. What does that do, in your opinion, to growth?
Well, growth's going to slow, and growth was going to slow whether Manchin had supported that bill or not. We were at a very elevated level of growth. It's unsustainable given the growth potential of this country. So it was poised to moderate. In fact, is starting to moderate. And as a result of that, inflation should moderate over time. And you've seen Americans unleash a lot of pent-up demand on the economy. Our savings rates have come down, and you see some signs of very modest improvements in supply chain dynamics. But that's what the market is focusing on. The question now is, if Omicron slows the economy more, does that mean inflation persists for a bit more because supply chain challenges may persist? And there's a case to be made for that. But I would also argue that we should start to see demand on the consumer side moderate as well. So I think we'll ultimately work our way through this. It's going to take some time. But what's critical is that the markets aren't focusing on good or bad. They're focusing on better or worse. And that's what I would be focusing on as an investor. Now, with regards to Joe Manchin, I don't view this as not wanting this bill because of inflation concerns. I think it's political concerns in what it represents a very red state. This idea of inflation, let's remember it was a couple of $1 trillion to be spent over 10 years. That's a relatively small percentage of the economy. And it's not like the money that was spent in the last year of the Trump administration or the first year of the Biden administration, which was direct payments to businesses and households, which could then be spent in the economy. This was going to be investments made in children, investments made in green policy, very, very different makeup. So I don't view that as an inflationary, a bill that was going to cause a significant amount of inflation. But what this does mean, if you don't have this passed, is a bigger fiscal drag next year, and all part and parcel of this story of an economy that's likely to moderate over the next months and quarters.
Well put. And we're going to do a deeper dive, or maybe as deep a dive, on the BB program in a couple of blocks here. But Brian, before we go, I want to ask you about your 2022 outlook. Not going to ask you what your S&P 500 target is for December 31st, 2022, but any broad themes you're looking at to start the year and what you like in terms of sectors, asset classes, styles, anything like that.
Yeah, so the first question I would ask is, where are you in the cycle? And as we talked about, I think it's a cycle that's going to continue certainly throughout 2022. So that has me favoring risk assets over, government bonds, cash, those types of things. Now, from there, directionally, where are we heading? It's an economy that's slowing. And as an economy slows, you want to favor less of what we favored when the economy was recovering. When the economy was recovering, it was all about deep value, cyclicals, commodities. As the economy slows, you want to favor higher quality equities, a bit more defensive, secular growth companies, which certainly hasn't been the case the first few days since the Fed spoke. But I would still go back to favoring those structural growth businesses in the U.S. and around the world. Now, maybe at some point as we progress through the year, if inflation moderates, could the Fed back off? Could we see Omicron concerns dissipate and the economy move back into an expansionary mode? Sure. But for now, as we head into the year, it's about the slowdown back towards a more reasonable level of growth. Inflationary pressures likely to moderate. I would be a bit more defensive in that environment. I wouldn't expect 20% returns, but I would still expect the markets to outperform the bond market, the equity markets to outperform the bond market.
And we got to leave it there, Brian. Always great to see you. And if we don't see you before the new year, happy holidays and a happy new year. Brian Levitt, Invesco Global Market Strategist.